Hey everybody, thanks for being here. Sunday at 1 p.m. Eastern, 10 a.m. Pacific, like we do every week for these live streams. Appreciate it. It's a great opportunity for me to reach out and talk to you in the community and share some ideas that I've had over the last few weeks. This week, a really important topic that we don't really talk about a whole lot on the channel. And we talk a lot about dividend investing, we talk a lot about value investing, but we don't talk nearly as much about growth stocks. And it's a great investing strategy if you know how to find them. So that's what we're going to be talking about this week is finding some of those growth stocks, how to use it, some of the risks involved, and really how to be successful. I see a few people joining us. Thanks for being here, Ishmael Smog. Shield from Nigeria, how to find these types of stocks. We're gonna get into that. So what we're gonna be talking about today, like we do every week, is first we're gonna be doing some community shout outs, talking about some of the comments we receive over the week. Love the comments. Every time somebody sends me a comment on the videos, I always respond to comments, and it's a great way to really understand what you want to see as videos on the channel, as well as get some feedback and get some ideas, and call me out when you need to. So appreciate the comments. Always love seeing those. We're going to also be highlighting a few of the videos from last week and the ones coming up this week. So and then we're going to get into that topic. So growth versus value versus dividends. I'm going to cover some risks in growth investing, as well as 6 factors that I use to find growth stocks. And these, like I said, we don't cover it a whole lot on the channel, but it's an amazing strategy. A lot more risk, and I think a lot more work than some of these other strategies that we usually follow. Talking about value investing, you're investing on fundamentals and the value in the company, which that's something that doesn't change a whole lot. Dividend investing, again, you're investing a lot on those fundamentals, so it's something that doesn't change a whole lot. Whereas with growth investing, that's something that can change from quarter to quarter. So it's going to be a lot more work and a little bit more risk, but the return is there. Okay. You see from the thumbnail that 5,800% return. That was the actual return on shares of Microsoft in the 90s. Okay, so over about a decade there in the 90s, Microsoft returned 5,800%. That comes out to about 50% annually. Okay, 50% return every single year there in the 90s for Microsoft shares. And you see it, all the time. Amazon, Starbucks, Netflix, all of them had their periods as a growth stock, and some of them are still growth stocks. If you look at Netflix and even Amazon to an extent. So what we're going to be talking about is finding the best growth stocks for their time, right? And I'm going to share with you those 6 factors that are going to help you pick growth stocks, whatever period you're in. So pre-recession, during recession, afterwards, and stuff like that. And then, of course, we'll get to that question and answer, which I love every week talking about. Thanks for, I see everybody joining us here. Christopher, Altar, Christopher. So let's get into it today because I really want to get to those growth stocks. But again, of course, I'd love to highlight the comments that we get each week, and I want to cover a few of those, a few of them that I really liked getting. So one, we got Stephen wanted a video on strategy of picking growth stocks, which of course is what I wanted to do for today's topic. So very well timed. And he also asked, something tailored to younger investors. Seems like younger investors should be focused on growth rather than dividends. So kind of a 2-part question. I want to get to those growth stocks because it's a great strategy, but also want to talk a little bit about that investing by age idea because, I think you can be a growth investor. You can be some of these. You can follow some of these strategies. So growth investing, value, dividend. You can follow these no matter what age you are. I think what's more important, by your age, is the asset allocation. So how much you have invested in stocks, how much you have in bonds, and how much you have in real estate, and maybe some of these alternative investments. Okay, so obviously, in your 20s and 30s, you're going to have a stock-heavy portfolio because that's really where the return is. Okay, so you're going to have maybe 55 to 65%, maybe even upwards of 70% in stocks, with a large portion in real estate and bonds as well, with the rest in bonds and real estate. as you get older, you're going to gradually shift to more protection, as you need it, as you need to start focusing from growing your portfolio to making sure your portfolio is there when you need it. Okay, so it's not necessarily which type of strategy you are, because a lot of times your strategy, your investing strategy, so whether you're a growth investor or whether you like value stocks or dividend stocks, that kind of thing, that's going to be a little bit more permanent. You're going to that's that risk tolerance that you have. If you're a very risk tolerant person and you don't mind seeing your stocks up and down a little bit more, then you can go into that growth investing. If you're a little bit more risk averse, so you get freaked out when the stock market rises and falls too much, then maybe you want to be a little bit more of a value investor bent or a dividend investor, right? But you can do any of these at any stage in your life. Just understand that you want to be making sure that you have, if you're an older investor and getting ready to needing that money to pay for living expenses, then you need to be allocating more and more towards bonds and towards real estate and really diversifying that risk out. And we've got a couple of videos on the channel about that, about investing by age. But again, thank you, Stephen, for that question. Actually, was what I wanted to cover with this week. So it's an excellent question. This next question was by Jay. He's always interested in seeing. This was a passive income video that we just had this last week or two, and he wanted to see more passive income ideas. Didn't necessarily want to see a lot of blogging articles, and I agree. Whenever you turn on a passive income or a online business video, it tends to be blogging. I agree with that, and it's just because blogging is so easy to do. It's so cheap to do. You need very little money to start a blog, and it's changed my life. But I understand that, and he wants to. But he says he's still having trouble, finding the right idea for him. So it kind of spurred an idea I had, and I ran a survey on the channel about this. What are your hurdles to creating that online business, to creating those passive income assets? So I created I did the videos, and you can see the survey here is, most people were saying it's just finding the right work from home idea that works for them. Okay, and this is really common. There's so many ideas out there for making money online, for creating your own business, and some of those passive income ideas that it's information overload. Okay, it's you don't know which one's going to work for you, which is so important. Understanding something that you want to do for 10, 15 hours of your week when you're still trying to juggle that family life and the 9 to 5 and all that. So important. But also a lot of people had problems with finding the time, that limited time to actually devote to starting a business. A lot of the passive income ideas I talk about can be done on as little as 5 or even 10 hours a week, but that's still tough to find when you've got a family, when you've got other obligations, and that 9 to 5. And then of course, a lot of people also were challenged with just growing that side hustle idea. Actually making it a success and getting a little bit of the risk off the table. So what I'm going to do is I actually created 3 videos around each of these. One, I look over 101 ideas, 101 side hustle ideas, and how to pick the very best one for you. And I walk through that. The next one, the second video in the series, is 5 productivity hacks and 3 ways to find time in your schedule. And this is a lot of these are what I used to create my own online businesses. Those 4 blogs that I run, as well as the other online businesses, while working a 9 to 5, while also studying for that professional designation, the chartered financial analyst designation, and managing my own rental real estate portfolio. So definitely a time in my life where I needed to find that extra time and make my time work a little bit harder for me. So I share some of those in that second video. And then in the third video is 10 business growth hacks that I've used to grow from basically zero in 2012, 2014, when I was just getting started, to a 6-figure income. I'm averaging about $10,500 a month over the last few months, over 2019. So from zero to 6-figure income, some of the business growth hacks that I used to do it. But I didn't want. It was a great question by Jay, and I didn't want him to have to wait the whole time. So I figured, I'm going to run over some of the highlights, some of the best of for the series real quick here. I want to get to those growth, how to get into growth investing real quick. But I wanted to cover these because like I said, side hustles and creating my own assets, online assets, have really changed my life. It's given me control over my own income. I no longer, have just collecting that salary no matter what I do. I can make as much as I want or as little as I want. I have that control over my own financial freedom and that feeling of financial independence. So it's something that I love talking about. I really want to share it with everyone here because, okay, if you hit that 50% annual return on growth stocks, okay, let's get back to the topic here. If you get that 5,800% return, that's all you need, right? But generally, even growth investors, you're going to be shooting for 10 to 15% annualized return on your portfolio. And it's not going to make you rich, okay? To really become financially independent, a lot of times you need to be starting your own business. You need to be creating your own assets and your own passive income assets to be reaching that level of financial freedom, okay? So stick around for the growth investing. Love talking about it, but you also want to look here. You also want to focus on those ideas of creating your own online assets. So I want to go real quick into these, what I talk about in those videos, and of course those videos are going to be coming out in the next couple of weeks. In that 101 ideas, so I'm going to share 101 side hustle ideas, kind of talk through them a little bit, and talk about how you can narrow the list down. Like we said, that's like we saw, that's the number one hurdle for a lot of people is picking the idea and getting started with it. Okay, so I'm going to talk about listing out your hobbies, your work, what you do as a profession, some of the classes you took or enjoyed in school, even your bucket list and your skills, and then 3 questions in that video to narrow down that list. Okay, and this is so important because you can, even if you don't necessarily have the experience or the skills in something, you can still make it a side hustle. You can still make money off of it. And that's some of the best side hustles, in fact, is where you're just sharing your journey, creating this online asset, creating this side hustle, and what you're learning and how you're learning to do it. Because that's what people are looking for, right? Is to share in someone's journey and understand how they made it possible for them. So we talk about that, and then the second video, that 3 ways to find more time, and then the 5 productivity hacks. I think this is a video for anybody, right? Even if you're not thinking about creating online businesses or side hustles, this is something anybody could use more time. So I go over those, and I share a kind of a unique system that I created for finding your time in your schedule. Okay, what we're going to talk about is kind of listing out everything you do in a week or 2-week period, and really talking about where that is for you. Okay, and then we separate everything out by important and enjoy. Okay, I show you how to create kind of a diagram, kind of a box. With important on one axis and enjoy on the other, right? So up here would be things that maybe are important, but you don't necessarily enjoy them. Over here would be things that are important, plus you enjoy them. That's where you live. That's your home right there. That's the stuff that you're really going to excel at. And then, of course, the other box is some things that maybe you enjoy but aren't really important to your success or your business. Those are kind of your reward things. And then down in the lower box, it's going to be some things that are neither important nor enjoyable, and that's where you're going to find a lot of that extra time to devote to a side hustle, or just lose those activities that you do to find extra time for your family, for whatever you want to do. Then I'm going to within those 5 productivity hacks, not only finding more time, but being able to use your time more effectively, right? We've all got the same 24 hours in the day. So the trick to being successful is just using those hours more productively and being able to get them to do more for you. So we're going to talk about a lot of focus on deep work, and that gets back to the idea of, everybody's heard of that 80-20 rule, so the Pareto principle, and basically what that says is 20% of your work, of your effort, the things you do, actually result in about 80% of the results, right? And that's the really important tasks that really move the needle on your business. Okay, and then you've got an 80% of the rest of the stuff that you do that is maybe it's important, maybe you have to do it, but it's not really moving the needle quite as much. Okay, so we're going to be talking about focusing on deep work, that 20% that really moves the needle, how to focus on that, and really how to make that important. We'll also talk about time blocking, which is a system that I use where you schedule out times to do something, to do that deep work. And it's a strict schedule where you only do that work in that time block, okay? And that's going to help you avoid a lot of these distractions and a lot of the things that are going to pull your time away from what you want to be doing. And then talking about how to use every single minute of your time. Just for one last little bit here before we move on, then that third video is going to be 10 business growth hacks, and again, this is a lot of the hacks that I use to grow my business from zero to six-figure annual income. And a lot of that is going to be moving from that one-to-one business model that a lot of people start off on online. Maybe they start off in consulting or coaching or things like that, where it's one-on-one. They're serving one customer at a time. And we'll talk about transitioning to that one-to-many business model, where you're serving multiple customers at the same time, whether it's through maybe group consulting, maybe it's through creating your own mastermind groups, ways to really spread your time out more and make money doing it. We'll also be talking about creating your own products, not relying on ads and affiliates and sponsorships. And I see so many people, whether it's YouTube creators or their own online businesses, doing this, is they think it's all about the ads that Google is going to serve up and pay you to post on your website or your YouTube channel, or affiliates and sponsors. And don't get me wrong, I make a lot of money off affiliates and sponsorships, but you will never create that financial independence for your business through those models, because you're always relying on someone else's product. I just got done reading Phil Knight's memoir about his creating Nike, founder of Nike, and it pretty much goes from when he was about 22, 24, when he set out to travel the world and got the idea to create Nike, all the way through his time of running the company. And it's really interesting that for that first 10 years, Nike didn't really make its own shoes. Nike was basically just a distributor for a Japanese shoe company called Onitsuka. It was actually Nike wasn't even Nike yet. It was called Blue Ribbon Shoes, and they were just a distributor. This Japanese shoe company manufactured their shoes, imported them over to the States, and Nike distributed them and sold them in the States. And it was a huge problem because they were always dependent on this Japanese manufacturer, which was often late, which tried to break their licensing agreement several times. So Nike never really owned anything. So that's what we're going to talk about in that video is really creating your own products, creating your own business and your own assets. But I want to move on here because I want to get to those that growth stock investing. Be on the lookout for those 3 videos, because this is, like I said, creating your own online assets, your own online business, or even a traditional business. You can use a lot of these ideas. That is really where you're going to find that financial independence and that financial freedom. Couple of channel notes. Last week's videos finished up that passive income series and some videos on student loans. I like to sometimes get out of the topics that we generally cover on the channel and just kind of talk about other things. So that was that. Next week's videos, we got a couple of interviews with Carl Richards of the New York Times and a couple of interviews on money and relationships. Friday, we've got a video on IPO investing. So a lot of you have asked, especially with some of the hot IPOs this year. Beyond Meat is up like 600% so far this year. You've got some other ones. Pinterest was a really popular IPO. A lot of you have asked me how I invest in IPOs. So I put up a video on that, going back to my days as a venture capital analyst. So my job was to analyze pre-IPO companies, private equity companies invest before the IPO for a lot of these venture capital firms. So I put all of that in a video, and that's coming to you on Friday. So that's going to be a real good video. Now let's get to this growth stocks topic, because I know a lot of you are excited to talk about that. I'm excited to talk about it because like I said, we don't talk a whole lot about it on the channel here. And I want to start off by talking about really how growth investing differs from value and maybe dividend investing. Obviously value and dividend investing, typically companies at later stages in their development. Okay, so a company, when it has sales, when it has profits and earnings, its decision is whether to reinvest all of those profits, all of those earnings, or to send that money back to shareholders as a profit and share in those profits. And a lot of times those value stocks and those dividend stocks are the ones that are going to give you the most money back in your pocket. But growth investing, it's no less powerful because while it's nice to get that dividend check every 3 months, growth investing, if the company is growing its earnings, that's ultimately a bigger share, a bigger pie that you have a share in. And we've got those examples of Microsoft, 5,800% return in the 90s, 50% annualized. Amazon, 880% return in the 7 years to 2017. Okay, and a lot of people could still argue that Amazon is still a growth stock because it still trades on some of those higher multiples and some of the factors that we'll talk about. And growth is still definitely there in that. But you look at other stocks, the whole FANG idea or theme. So Facebook, Amazon, Apple, Netflix, and Google. Stocks this decade, and it's a really powerful strategy. But there is a lot of risk. So I want to share this graphic with you, kind of how growth stocks have performed against value and the S&P 500, and we've actually seen a really big change over the last decade since the 2008 recession. Typically, historically, before the recession, value stocks beat growth stocks over the long run, right? You always saw, and in fact, we had a thing called the value premium, right, where we talked about how value stocks beat growth stocks over the long run. And a lot of it was just because growth stocks really fall off in a recession. They give back a lot of those returns, maybe even a decade's worth of returns during that recession. Whereas value stocks, they're already cheaper, relatively cheaper and relatively more value, so they don't fall quite as much. And the longer term returns tend to be higher. What we've seen over the last decade, and this is a really interesting change in the markets, and something that people are still trying to figure out what's happening. But growth stocks are actually beating value stocks over this last decade. And here we've got just a graph over the last 5 years. You see growth stocks measured by the Russell Top 200 Growth ETF. The IWY is 63% cumulative returns, which is pretty strong. Especially when you consider the S&P 500, which hasn't been doing badly. It's been doing pretty well for most of that period. 40% cumulative returns, and then value stocks clear down at 21% returns. So growth stocks have beaten value stocks over the last 5 years by a factor of threefold. So definitely a strategy that you don't want to completely ignore, even if maybe you're a little bit more of a value or dividend investor. And we'll get to those 6 growth factors, 6 factors to look for in growth stocks. But there are really two growth investing strategies that you want to kind of consider. One is just a pure growth strategy, where you're just looking for the strongest growth over in a sector or in an industry. And this is something we'll talk about. It's something we talk about on the channel, where you're not investing across the entire market, okay? You're investing by sector or by industry, okay? You want to find the growth stocks within that industry, because if you're just looking for stocks with the highest amount of growth, you're probably going to have most of your portfolio in just like tech stocks or biotech or a lot of these very high growth sectors or industries, right? Well, what happens when you get some headline risk on that? What happens when the government starts blacklisting other foreign tech companies, and that's to where they can't buy products like chips, semiconductor chips from U.S. companies. This isn't just a fictitious example. This is actually what's happening with Huawei and a lot of these U.S. semiconductor companies. So you really want a diversification in your investing strategy, whether you're a dividend investor, value investor, or growth investor. Here, you want to be looking at individual sectors. So start off with the 9 or 10 individual sectors, consumer discretionary, consumer staples, utilities, all of those, and then be looking for the growth stocks within each of those, okay? And what that's going to do, that's going to give you, a list of 10 or 15 growth stocks spread out across the industries, across the sectors, and you're going to be a little bit more diversified and have a little bit less risk than than just going for the highest growth stocks across the whole market. But then that's kind of a pure growth strategy, right? You're just looking at growth. You're not really looking at the price or the valuation of the stocks. And the alternative to that is going to be it's called GARP, right? It's growth at a reasonable price. And for when you're doing this, it's kind of a happy medium between growth investing and value investing, right? You're still looking for the stocks with the highest growth in a sector or in an industry, but you're also kind of balancing that with valuation, okay? And what we'll talk about in these 6 factors is the risk that that these growth stocks are so expensive on a price to earnings multiple or some other valuation metric that you're really investing on sentiment, okay? Investor sentiment is going to control where a lot of these stocks go. And if that sentiment falls during any quarter or even over a longer period, then you're kind of screwed, okay? Because there's not a whole lot of intrinsic value in these stocks. So what you do as a GARP investor, as growth at a reasonable price, is you get your list of within a sector, your list of higher growth stocks, and then you kind of look at the valuation as well. You look at the PE estimates. You look at the price to cash flow and price to sales metrics as well. So, but what I want to do is get into those factors. Well, let's talk about kind of the investing risks behind growth investing. And this is gonna bleed into those factors pretty easily, pretty quickly anyway. First is just that sentiment, okay? This is the number one factor you're investing in with growth investing, okay? You're not investing in the fundamentals of that company. You're investing in investor sentiment, okay? Because when you look at some of these, Tesla has a negative earnings per share this year, right? They're not making any money, okay? But they're expected to make $5.40 a share in 2020, and I think it's about $11 a share in 2021. So you're investing on that growth and how much investors are willing to pay for it, okay? Tesla used to have something like 100 times earnings per share, 100 times price to earnings ratio, because investors were willing to pay that much. Right now it's right around 39 times next year's earnings. But then you compare that against some of these other traditional companies like Ford, which is right around 7 times earnings, or for GM, which is right around 10 times earnings. So you're not necessarily investing just for Tesla's growth, just for the promise of that $5.40 in 2020 EPS or the $11 in 2021. You're investing in what investors think about that, okay? And this is one of the real problems with growth investing, is that it's so hard to keep up with that sentiment and to be able to see where that's going, because when that sentiment falls, like we've seen in Tesla, in fact, with that 100 times price to earnings ratio that they had, it's come down to about 39 times now. Even though it's still expected to hit that $5.40 earnings per share in 2020. Okay, so those estimates, those expectations haven't really changed. That earnings expectation for next year hasn't really changed. It's the investor sentiment that has. Investors aren't willing anymore to pay 100 times per that share. 100 times per earnings. They're only willing to pay 40 times per earnings. And as a growth investor, you need to understand that, and you need to be in front of those changes. Okay, and that's kind of something we'll look at in these 6 factors that we'll talk about. You also, so just some investing risks is the industry competition and changes in the industry. A lot of regulatory changes. We'll stick with our Tesla example here, and within the electric car industry, you've got changes, competition where all the major car makers are making electric vehicles. Okay, so that competition is only going to increase for Tesla. Regulatory changes, like some of the rebates that the government gives people for electric vehicles, obviously those are always at risk and something that you need to watch for, because if those go away, then that ultimately changes the sales expectations for a car. Another risk, a big risk in growth investing, is just a recession, or an economic downturn, because that's going to hit these growth stocks much harder. They typically have higher debt leverage, and that price to earnings ratio to where, if anything calls in doubt those forward earnings, so that 540 for next year's earnings per share for Tesla, anything that calls that in doubt, that's going to hit that investor sentiment and re-rate how much investors are willing to pay for that. But now let's get to those 6 factors that we're going to talk about, and I see some questions coming through. I want to get to those, but let's get through these 6 factors, and then we'll cover all your questions. So I want to share. Here it is. So the 6 factors that you can use, and a lot of these are kind of things you can filter for, things you can screen for in a on any kind of online stock screener through your platform or whatever. But I want to talk through them because it's not just about filtering for a stock, filtering to find a growth stock. You have to understand what these factors mean, and really how they help you stay in front of that sentiment shift and stay in front of some of these growth stocks to really get the growth stocks before they're growth stocks, right? Because a lot of these whether Tesla's still a growth company or not 5 years from now, you have to be able to tell where it's at right now and whether its run as a growth stock is going to continue. So one of the first things I use is just filtering for companies in sales and earnings growth in the top quartile of their industry, right? And we talked about this, and this is really what we're talking about, is not just growth stocks and not just earnings and sales growth across the market, but within their industry, right? It's any tech company can produce 10% year-over-year sales growth. I mean, it's tech. It's growing at that rate. Okay, so if you're just looking for sales growth, just organic sales growth, you're going to have all these tech stocks list, but you're not going to have anything from utilities or consumer staples or a lot of these other non-cyclical sectors, right? So you want to start your filtering or your screener with each individual sector or even each individual industry a lot of times, because even within sectors, so like healthcare has biotech and it has pharmaceuticals and hospitals and services, for very different industries as far as fundamentals and as far as growth and earnings. So a lot of times you want to look at by industry, and yes, search for the top quartile, the top 25% in your sales and earnings growth. Okay, that's really gonna find you the fastest growing ones within those factors, that competition and that industry fundamentals. Okay, then you're going to want to look for companies with accelerating sales and earnings growth. Okay, and this one and then the next one, this is really going to speak to that idea of the investor sentiment. Okay, like I said, one of the most important, probably the most important factor in growth stock investing is that sentiment. Okay, so you have to make sure that investor sentiment, okay, how much investors are going to be willing to pay for those forward earnings, for those future earnings and sales, stays at that elevated level. Okay, you want to make sure that even if investors in Tesla aren't ever willing to pay that 100 times, next year's earnings again, at least they're willing to pay that 40 times or maybe even a little bit more, 40, 50, 60 times earnings. And this is how you do that. You look for companies with accelerating sales and earnings growth. Okay, a lot of these companies, they put out spectacular earnings growth in one quarter, but they can't repeat it. Okay, and that's where you get those cracks in that investor sentiment, is when when a company can't beat those earnings estimates. It has that decelerating sales and earnings growth, even if it comes down to Tesla growing sales by we'll say 60-70% a year. Even if it comes down to 30% sales growth or 30% earnings growth a year, that's still spectacular for a car company, but not for Tesla. Okay, so you want to find those companies, filter for those companies with accelerating sales and earnings growth. Okay, you also want to filter for companies with higher earnings and sales estimates in the future. Okay, so a lot of platforms, I use E-Trade for a lot of my sales and earnings estimates. And it'll show you the analyst expectations over the next year or two, or even 3 years sometimes, for this company, right? And obviously, you want to look for companies with earnings and sales expectations that are higher in the future, but also a record for beating those. Okay, and this is a big game played on Wall Street. Management always tries to manage those earnings expectations. Analysts, of course, try to get as close as possible to what the forward earnings are going to be. But it's a game, a lot of times, especially in the fourth quarter. Usually, companies will come out and they'll kind of, give a little bit lower expectation or a little bit lower commentary for their next year's earnings and sales, trying to bring those expectations down a little bit. Okay, they're trying to manage those expectations by analysts and by investors, so that when the earnings actually do come out, when that first and second, third quarter earnings actually come out, they can beat it and say, hey, we didn't think we were going to be able to do it. We worked hard, we did it, and here we are. Reward us for it with a higher stock price. So you really want to look at a company's history of beating expectations. Okay, so some companies like Apple always beats expectations. They're like the king of, Tim Cook is the king of managing these expectations and then being able to beat earnings estimates when they come out. But some companies not quite so much. So you really want to look for that record of beating expectations, because of course, again, this plays into that investor sentiment. Okay, the investors are going to be looking, going to be used to the company beating expectations by a certain amount, or whether they do or don't beat expectations, and then that's going to influence that sentiment when those earnings actually come out. So even a company that has a history of beating expectations, if it usually beats by 2 or 3 or 4%, if earnings come out and it only beats by 1%, or if it just meets expectations, that's going to hit that investor sentiment, and that's going to obviously drive the shares down, because there's a little bit more uncertainty around those. Another one I like to look at is operating margins, and this is probably my favorite metric for finding stocks, is operating margins. This is, if you look at the income statement of a stock or of a company, then you'll have sales, and then you'll have cost of goods, which is the price or the amount of money that a company pays for its raw materials, right? It pays its suppliers. Okay, that gives you your gross profit. Then you have all your operating expenses. Okay, these are the actual expenses it takes to run that company. Okay, so you've got your staffing and your running your factories, all of that stuff, marketing, that kind of thing, and then under that you'll have your operating profit or your operating income, right? So that's your gross sales minus everything it costs to run the company. And that's your operating income. That is the profitability of the operating profitability of a company. Everybody likes to look at that net income below, which is after taxes, which is after your interest payments, all of that. That's financial leverage. Okay, there's a lot of accounting shenanigans and financial engineering that companies use within those taxes and within those that leverage, that interest payments, to make their earnings look better, right? But that operating income, that is pure. That is the pure operational profit of a company. So what I like to look at is that these operating margins, so the operating income divided by their sales, that profitability is at least flat or improving, or flat or going up. The problem with growth investing a lot of times, of course, is these companies, they're trying to grow so quickly, and they have to grow so quickly to meet those expectations that maybe they're not quite as profitable. Okay, they take on a lot of acquisitions. They take on a lot of new staff to be able to meet those growth expectations and those increasing sales. So maybe their operating profitability isn't, is maybe a little bit more volatile, or maybe it's even declining a little bit. They're trying to make it up on quantity. Okay, right? Yeah, that old joke. Everybody wants to make a profit. Well, you can't be profitable. Well, I'll just sell more and make it up in quantity, even if I'm not quite as profitable. But the real standouts, the really well-run companies, okay, within growth, and these are the companies that are going to reward you, because that management is so good at creating that growth, but also creating higher levels of profit, that those are the ones that are going to be able to grow your share price. And those are the ones that, even as they grow by these double digits every quarter or every year, sales and earnings, they're also able to become more profitable while they're doing it. Okay, so at least flat, but preferably you want to see improving profit margins, improving operating margins as well. And the last two here are just kind of some qualitative analysis that you want to look for within growth stocks. Catalysts for growth, things like new products, new services that they're doing. One very important thing you want to look at when you're looking for growth stocks is that they're not just growing by acquisition. Okay, this is a big problem with a lot of companies, especially companies in the pharmaceutical space. A lot, there's not a whole lot of sales growth there. So basically, over the last 10 years, with debt costing next to nothing, they've just been buying other companies. It's growth through acquisitions, and of course, that's just building up that debt load, to unsustainable levels, really. And you see a lot of those stocks falling off now because of that huge debt burden, and sales still aren't growing. But they've got so much debt they can't really grow much more through acquisitions. So you're looking for that organic growth, okay? Companies that are creating new products, creating new services, reaching new markets, through their own organic growth, and really creating that growth through their own company, rather than it's okay if companies acquire other companies as well, but that shouldn't be their primary growth strategy. Okay, they should be growing organically. And then last here is just doing some industry analysis. Okay, is that growth stock, that growth company protected in some way from too much competition? Amazon's a perfect example of this. There's almost no barriers to entry to becoming an e-commerce site and doing a lot of the things Amazon does, but Amazon's just got the massive scale and the power and the financial flexibility to, that nobody else can really touch it. So that's really been the kind of the theme to e-commerce over the last decade is Amazon, and then all the also rans as well. One of the biggest stories in business is when over 5 or 10 years, almost Walmart was trying to keep up with Amazon, pushing so much money towards its e-commerce platform, its business model, trying to shift online, and it was having no success at all. And then finally, somebody put up a banner in the office: "You can't out Amazon Amazon." Okay, and it really speaks to the competitive advantage that Amazon has in that e-commerce space. And after they realized that, then of course Walmart started shifting its business model, started doing some of these other products like curbside pickup and some of these other conveniences that has helped the company grow within its own niche, within its own competitive atmosphere there. So not trying to out Amazon. And the moral there is a couple ideas, but here it's just that you want to look for industries where a growth company has those competitive advantages that are going to protect that growth. Okay, because remember, that's what we're talking about. You're investing in that future growth, and that's going to keep on going, because that's really what you're paying for on the shares. So those are really kind of the 6 factors that I use to screen and to look for growth stocks and make sure they're going to keep on growing to where it's going to keep on producing that higher share price. I want to open up to question and answers here. I saw some coming through earlier, but if I don't see it, I'm going to scroll through and see if I can pick up on some of these earlier questions. If I don't see your question though, ask it again in the in the comments or in the chat here, and I will. I'll be sure to get to it. A lot of people found a good thing every week. Gains through him back. So, again, thank you everybody for joining us here. I see a lot of people that come back every Sunday, and I love to see that because this is just my chance to kind of relax and be with everyone here. Some Yoli from Arizona. We've got from Jeffrey from Hawaii. From Brussels, Belgium, Salve 236. He's been here a couple of weeks. Thanks for joining us, Christopher. Connecticut, the tax state. Yep. So dedicated video stream on passive income. We'll definitely be getting that when I run that 3 video series on side hustles and really how to find the perfect side hustle for you, and then how to find that limited time to run it and how to grow your business. We'll definitely do a live stream on that to answer all your questions and get into that. Water ETFs, what do you think of a big holding in CGW with strong gains? I don't know CGW. Is that that might be the water ETF? Water ETFs are hard. Water investing is hard because it's been years that people have been talking about, scarcity in water and that kind of thing. And it really, hasn't so much played out for a lot of them. Yeah, it might in the future. So yeah, the Invesco S&P Global Water Index (CGW). I see it's a 1.9% yield, so pretty much the same as the market on the return. And so 5 years, it's done well since 2016, so about a year and a half. But if you look further out, then kind of market returns, right? But it's definitely a hard commodity to invest in because there's new technologies coming out that are going to limit that idea of water scarcity, desalinization and things like that, where these some of these water utilities aren't quite as valuable as maybe we thought they were. What else do we have? From Toronto, it's all a crapshoot. Monica says it's all a crapshoot with growth investing. I assume that's what you're talking about, and not necessarily. There are ways to find these companies with a competitive advantage, where investor sentiment is going to remain strong. They have that history of rewarding investors. So it's not necessarily, a lot of people like to call all investing speculative or gambling, and it's not. It's you're making educated guesses or educated bets on these fundamentals. And sure, it's kind of a one way or the other kind of idea, but it's not that binary, black or red kind of bet that you make on a roulette table where there is nothing you can do to understand where that ball is going to fall next. Okay, it's black or red, you got 50-50 shot, and there's nothing you can do to influence that or know where it's going. With stocks, there is analysis that you can do, things that you can look for, like we talked about, that can actually give you a better than average idea of where this stock is going and how it's going to reward investors. But there is that sense sometimes that it is, especially when you're talking about investor sentiment. Okay, like we saw in these growth stocks, you have to be able to kind of get a feel for the market and feel for what other investors are thinking, because whether a company grows or not, if that investor sentiment falls and they're not willing to pay that 39 times price to earnings, then that stock price is going to fall. Some good intrinsic value models we can use to find promising companies. I'd have to research that some more. I know there's some models that people use, like the CanSlim model, and if you're talking about specific screens or specific filters, I guess, then I can look into that and get back to you on that one. For valuation, for value, I like to look at the enterprise value to sales. Okay, a lot of times, and that's EV to sales, because what you'll see a lot of times is, and something we've talked about on the channel is things like that price to earnings multiple are terribly off, right? Earnings are something that is very heavily manipulated by management, that income statement. So taking that enterprise value, or that market value of the stock, which is just the market cap, so the market capitalization that you see on any online platform, that minus the cash on the balance sheet, okay, and then plus the debt, the long-term debt on the balance sheet. Okay, that gives you, if somebody wanted to buy that company in an acquisition, that's kind of the price they would have to start off negotiating right there. Okay, and then divided by sales. Of course, sales is much harder to manipulate than than earnings. Okay, because it's that actual sales that a company books. So that enterprise value to sales is one valuation filter that I like to use, and comparing that to other stocks in that same industry, okay, to get an apples to apples kind of idea, rather than trying to say, okay, EV to sales of a tech company versus a utility company, that kind of thing. Okay, what else? Trying to see if there was any other. Hey, Lydia, it's been a while. Lydia Santiago, got a great channel there, My Investment Journey. Trying to see if there's any more questions that I missed. Is that 21% reinvested dividends? Okay, with the dividend return that we saw, I think that's only with only the price. So Yahoo Finance, usually in the charts, it's just price, the price appreciation. So even with reinvested dividends, over the last 5 years, I don't think it would be able to get up to the S&P 500 return of that 40%, but not necessarily, definitely not up to that 60% return that we saw on growth stocks over the last 5 years. Would you be able to help understanding some terms that you use commonly, examples of what they mean? Yeah, sure. I mean, that's that's actually, we had a live stream. One of the first live streams we did was on investing terms. I don't quite know which terms you want to know about. So if you want, just after this video is over and it takes about an hour to process, go into the comments and maybe share some terms that you want to know more about. So it's kind of hard to tell which terms you want to see and explanations for them. How do you feel about emerging real estate trends based on stocks like where storage units or elder care facilities? I mean, it's really two questions there, right? Real estate. So TNR Wealth Strategies wants to know about. Are you talking about emerging economy real estate, or some kind of like an emerging trend in real estate in properties? So within the U.S., trends in warehousing, public storage, elder care facilities, or are you talking about investing in properties outside of the U.S. in emerging countries? Okay, so if you're talking about just the different property types, and this is an important idea when you're talking about that real estate portfolio, part of your entire portfolio is getting that diversification in different property types, right? Because there are going to be trends in things like so warehousing for e-commerce, Amazon, Walmart, that kind of thing. So warehousing probably will see a pretty significant growth over the next 10 years. I mean, it's hard to getting into that. You would have to also look at trends in transportation. So the automated trucking trend is obviously going to have a big effect on where warehouses need to be. You've also got other factors that determine that, but obviously that whole e-commerce trend where if a company can deliver something in a day, they don't necessarily need all these different retail outlets. Maybe they don't even need a lot of the warehouses, though. If you look at drone delivery, how fast a drone can fly and how long it takes to get from a warehouse to someplace in a day. So some good trends in warehousing, but also some caveats there. Other trends, obviously, if you look at demographics with the aging population, then you've got hospitals, you've got elder care facilities, things like that have really been on that trend for the last 10 years. Okay, what we've actually seen, and especially a lot of these healthcare REITs that own the senior facilities and things like that, is they built up so much ahead of the baby boom trend that there was actually an oversupply of a lot of these senior care facilities. So a lot of these stocks, these REITs, I'm thinking like Ventus, VTR. There's another couple within that space that the stock price actually didn't do very much for a very long period there because there was such an oversupply of senior care facilities. So although you had this huge trend to more demand, the companies had gotten so far ahead of it that you really have to watch out. And so whenever you're looking at something like that, if you're going to be focusing on a specific trend. Now, that's not to say that you can't just buy a REIT like a VNQ that holds all the REITs, or get a diversified portfolio of a lot of these that it still can't be a good investment if you just a huge diversified bet. But if you're going to be focusing on a specific trend, then you really need to know the fundamentals and the market dynamics that have been controlling that trend even before that supply and demand boom that you're looking at. What else? So we got VU. Somebody's asking about VUG, and this is the Vanguard Growth Index Fund. Haven't really followed it much. I mean, it's done well, obviously. Just that growth dominance that we've seen since 2008. So it's obviously it's benefited from that. It's probably Vanguard's always some of the lowest expense ratios in the market. Expense ratio of 0.04%. So basically free almost to own this fund and to have someone else managing your growth stocks. I would say it's probably, I mean, if you're trying for those huge returns on like we talked about, the 5,800% return on Microsoft, the 880% return on Amazon. You're not going to get that with a fund because it's spread out over hundreds of growth stocks. So you're going to get that general growth trend, and if growth investing continues to beat value investing, you'll do well. You'll get those good returns, but you're not going to get those triple-digit returns with a growth fund. But it's a great stress-free kind of idea. This one even pays a 1.2% dividend yield, which is different for a growth fund. Most don't pay any kind of a yield. So if you just want that stress-free, diversified, all-in-one bet for growth investing, it's hard to beat any Vanguard fund. But that Vanguard appreciation one, the VUG, is probably a good bet. Thoughts on Facebook and cryptocurrency? I can't touch it. I don't know. I haven't looked enough into the Facebook cryptocurrency that it launched just last week or a couple of weeks ago. I know they launched it. I don't know enough about it, whether it's available for investment or just kind of a buy and use kind of thing. For Bitcoin and other cryptocurrency, I've come out when I first started the channel. I was against owning Bitcoin. That was right around the peak in December and January of 2017, 2018, January 2018. Looking at just some valuation techniques that you can use. And there's actually a valuation technique that you can use for valuing Bitcoin and really any stock, any company that uses that social network like Facebook, like Twitter. It's been eerily prescient on the valuation of a lot of these companies. And it's really just kind of valuing the social network and the use that or the value in that social network. And I want to see what's the theory value crypto. I want to get the value or the name of Metcalfe's law. Okay, so if you want to learn about you want to learn how to invest in cryptocurrencies and how to value them, then look up Metcalfe's law. Okay, it'll tell you kind of how to value that social network and the use in that, and that's a really good way to see if Bitcoin or other cryptocurrencies are too overvalued now or not. Like I said, I came out against it right around that peak, December, January 2017. About a year ago, then I actually included in a video in investments that you can make. It was right around $4,500, $5,000 per Bitcoin. Then, and looking at using this Metcalfe's law, it actually was close to fair value. Okay, Metcalfe's law for Bitcoin says it's should be valued right around $3,500, maybe $4,500 per Bitcoin. When you value it just on that network. Okay, so I came out, I was like, okay, yeah, if you want to invest in Bitcoin now, it's as a longer term kind of an idea. I actually bought some Bitcoin myself, bought about $10,000 in Bitcoin, and and since then it's up to $8,000 now, and I've actually sold out of most of my position there, just taking some profits because it has run up so far so fast and beyond this intrinsic value of that social network. So yeah, if you're interested in Bitcoin, beyond what everybody on YouTube says, what all the other pundits say, just learn Metcalfe's law and how to apply that to Bitcoin, and you should do pretty well actually. Do a video on futures trading and Forex. Yes, I'm trying to get that one. For your response, what do you think of high yield stocks as part of your portfolio? Actually, we did a high yield, so high dividend stocks a few videos ago, and I'll link to that in the comments or in the comments below this video. It's actually dividend stocks, 3 high dividend stocks safe from market crash. Okay, so I don't think I put it in the video description, but I will put it in the comments. Actually, it's ranking the 5 highest dividend stocks in the market that I could find, and really some of the risks to watch out for. It's not just dividend yield. You're looking for that total return. Okay, so you're not just looking for stocks with a 10% plus dividend yield, because what's the point if the stock price comes down by 20%? Okay, so it's really about finding those stocks that are going to give you that total return as well as the cash yield. we're heading on an hour, so I want to thank everybody for being here, for joining us this week. Again, a great part of great part of my week being able to do this back and forth with the community. Go to the videos, ask any comments you had. If you had a question that I didn't get to about growth stocks or about investing in general, and watch for those videos next week. Like I said, that IPO video coming up next Friday is going to be a huge one. It's going to show you not only some of these IPOs that we talk about this year, but how to invest in IPOs. I share a strategy, two valuation strategies that I used while working for venture capital firms on picking pre-IPO companies and how to actually value, get the fair value of an IPO stock. So watch for that on Friday. A couple of the other interviews this week, and I will see you next week.